Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. We all understand the importance of data and how powerful data can be when you use it correctly. There is so much data out there in the world that people can harness or are trying to harness and use that data to create decisions in business decisions. Well, the use of data to uncover investment trends and opportunities has really exploded over the past few years. Yes, data can help uncover investment opportunities, but the huge amounts of available data today can also cause some issues. Well, I have the perfect guest on to discuss these topics and much, much more. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I would like to give a very warm welcome to Andrew Skatoff. Andrew is the founder and CEO at Bancreek Capital Advisors. Andrew, thank you so much for coming on the show. It's really such an honor to have you on. So thank you. Can you please just tell us a little bit more about yourself and Bancreek Capital Advisors?
Sure. And Ryan, thanks so much for having me. This is very exciting for me to be on the podcast. So happy to be here and happy to talk about data. So just a little bit of background about myself. Actually grew up in South Florida and over the years slowly migrated my way north, working my way up to New York City, where I guess the most relevant thing was spending 11 plus years working for a large single family investment office and developing a strategy that over time became the framework for what we're doing at Bancreek. So after the 11 years there, I ended up leaving to start Bancreek with our three partners. And our process culminated in the launch of our ETF platform, which we launched late last year. And we have two ETFs, BCUS, which is our Bancreek US Large Cap ETF, and BCIL, which is our Bancreek International Large Cap ETF.
Fantastic. So if I remember correctly and doing some research, it was about this time that you launched them or close to. So congratulations on a year of your ETF strategies. I am confident that they are bringing in lots of assets and moving forward. So congratulations there. And I love that transition from family office, learning about the family office and taking those strategies and making them more retail oriented. As we know, family offices, they invest a little bit differently than the retail side. It's much more alternatives, private investments, direct investments. So it's interesting. I love that you're bringing it to the retail side. So what did you learn while working at the family office, and how did it impact your transition to creating Bancreek ETF strategies?
Sure. So probably makes sense to back up. Just prior to joining the family office, I went through the value investing program at Columbia. So like yourself, was kind of rooted in this deeper dive fundamental research. And that's what I did for the family for a number of years, to your point, on all different asset classes, but primarily direct public equity and direct private equity investments. And the one thing that I took away from the family, one of many things I took away from the family office world, was how valuable having duration in your capital was. And it allowed me to look for the types of businesses that made the most sense for capital that had a long runway. And what I noticed was early on where there were very specific investments that the family had owned for decades. And these businesses just kind of worked in the background, compounding capital, in some cases low double digits over 30, 40 plus years. And it was really interesting to me because I wanted to dive into what drove these businesses to be able to compound in that manner. And I would say I spent a number of years kind of looking into these businesses and really identifying underlying attributes that made these businesses so valuable to own for long periods of time. And as I was kind of going through that process, I was becoming very interested in data science, so things like information theory and so forth. And as I was learning more and more about data science, the question that popped into my mind was, how can I take data science and make the process of searching for these types of companies more efficient. You're typically used to thinking of setting up screening tools or, kind of digging in or going to luncheons and talking about ideas and sourcing it that way. And as I learned more about big data and what we could do with it, really the question was, how can I make this more efficient? Spent a number of years kind of melding the two together and created a strategy that I ran for the family internally for a number of years, ultimately leaving in 2021 to start Bancreek with my three partners, two of which are on the investment team with very heavy data background, and really was the primary driver for me wanting to leave because I thought we could do so much more. My background isn't in engineering and coding and things of that nature, but I just so happened to grow up with a couple of very great friends of mine that happen to have that specific background. And so that really led to us leaving in 2021 and starting Bancreek.
Fantastic. It's interesting. I love that you brought up duration and compounding. As we all know, one of our greatest assets for all of us is time, right? Or duration. And then you talk about compounding. Einstein, one of the greatest quotes in all of investing, he's, compounding interest is the eighth wonder of the world, right? So exactly, start early, you got time, compounding interest, and then you brought data into it. It's fantastic. What was there any? Was it a difficult change in your mindset? You talked about being a true fundamental
Yeah.
value investor. You know, that's really what I think. I look at fundamentals, right? And I'm not smart enough to dig into the data and be a data scientist, so I like to focus on fundamentals. Was it difficult to transition from fundamentals, being a value investor, to more data driven quant investor?
Yeah, so it ended up actually being, I think, very helpful for me because we still look at fundamentals, but now we can quantify not only what fundamentals we should be looking at, but the duration of a specific fundamental metric to be looking at. And it's really making that process more efficient. So, when we think about what we've done over the years with building out kind of our internal proprietary tool set and engine, it's really identifying a combination of fundamentals and custom quantitative features that really help you analyze the data, process all the data. It's like signal processing to figure out what specific assets, tend to produce the best returns over time. And what we figured out is there are certain patterns of the data that lead you, to these collection of we call them structurally advantaged business models, quality businesses, whatever you want to call them, businesses with edge. These are the things that we're searching for. And we're really just taking all of the data that's out there in the public markets. And that's the beauty of the public markets. There's so much data. And so if you know how to assess and go through the data, you can use it to your advantage. And that's kind of the crux of what we're doing at Bancreek.
You made such a great point there, Andrew, about the amount of data. And that's what's great about public markets is the amount of data. And now there's alternative data sets, right? People are, some of the hedge funds now went to Robinhood and, bought their data. And there's just so much data out there, just like you said. How do you sift through all that available data and focus on eliminating the noise that's in that data to really uncover meaningful data points and trends and making your investment decisions? I think just uncovering and realizing what is noise has got to be one of the most important pieces of that puzzle.
Yes. So the first thing I did was bring in my mind, the top data scientist in the country, Anton Yen, who also just happened to grow up with me in South Florida, number of years at Lawrence Livermore National Laboratory doing exactly this signal processing, data simulation, was very much well versed in data science and information theory. We would chat over the years when I was still with the family office about, hey, here's what I'm thinking. Can we actually use data science for this? And he actually ended up like going back through his old textbooks and saying like, oh my God, there is a way to apply this, in this small sliver of the textbook to investing. And when I decided to leave, I talked to Anton. He said, yes, let's do this. And so having Anton is incredibly valuable because we can kind of work together to say, here's my framework for investing, or here's what it was. Let's figure out, what I thought was valuable, see if it actually is valuable. and then you test it. You're collecting like billions of data points and running millions of models and reiterating over and over and over again, adding different assumptions and features and seeing what is actually most relevant. And that's how you filter out some of the data noise. Because it is, you're right, that is the challenge because there's so much data. You need to find the most reliable data sets and go from there.
And like you said, it definitely helps having longtime friends who can help you do that, right? And nothing against my longtime friends, but being from Wisconsin, we talk a lot about farming, agriculture, the Badgers, Packers, and weather.
All great conversation topics for sure.
Yes, and beer is often one of the topics too. So it's fantastic. I love that you can leverage those great minds that you've been friends with for a long time. And you mentioned technology too. You mentioned that a few times about innovation, making the process that you learned at the family office more efficient. How
Yeah.
has it helped your investment decision making, and especially with AI being so much more accessible? Is that kind of changing the game here also?
Well, I mean, really, AWS has made all of this possible because the computing power that we have at our fingertips is amazing. And even like 5 years ago, this would have been a much greater challenge for us. But that's really what we've been able to leverage as all of this computing power becomes available to everybody at a reasonable cost as well. If you think of like a startup, if you need to like buy a bunch of supercomputers to be able to run some of the programs that we've created, like that's a challenge. Whereas we can just leverage AWS and have it run in the background for whatever, a couple cents a minute or whatever it ends up being. That's incredibly helpful for us and allows us to continue to go back and retest and assert different assumptions. Otherwise, it would be cost punitive to keep doing that. So I would say that's the major innovation that has helped us. The other thing is the ETF platform and being able to bring our engine and find a tax efficient vehicle that you could bring to everybody that wasn't available either like 10, 15 years ago. And because it is now, we're able to bring our actively managed strategy to the masses and in a tax efficient manner. And that for us was the most exciting process of figuring out like, oh, we can actually use the fully quantitative version of our process. Remember, my background was fundamental plus kind of this data science overlay. So when we initially left, we were managing capital and still are using this dual approach. But the engine and the process has improved so much over the years that we felt compelled to bring it in a purely quantitative form in the ETF structure.
Fantastic. I'm really glad you brought up ETFs. ETFs, is such a fantastic vehicle, and you're exactly right about a tax efficient vehicle that retail investors can use, easily accessible. And now, whether it's active strategies like yourself, a quant strategy, or now you have alternatives that are wrapped up into an ETF, it makes it so much more accessible, to gain exposure to these for retail investors. You know, are we obviously you're probably biased to ETFs, but are we you think at a breaking point? There's so many ETFs out there. What's your thoughts on the ETF market? Should we, I feel as like every day we're getting all these really unique strategies out there that are kind of like eye-opening.
Yeah, I mean, it's definitely there's definitely a sea change like happening. So whether it's like thematic investing or conversions of mutual funds into ETFs, I think people are recognizing the benefit of having it in ETF form. Really, as an investor, you just got to go through carefully and decipher like, what's the actual strategy here. You look at the ETF market; a lot of them are very similar to the overall market, plus or minus like a tweak. And they might charge more fees than just like owning a passive ETF, and that might not be a compelling way to deploy capital.
Mhm.
For us, we wanted to come to the market with something totally unique, which is a fully quantitative approach to active management. So when you kind of look at our portfolio, we look very little like the broader markets, which I think gives our investors a chance to diversify away from the heavily concentrated big tech trade that has done quite well for the last few years into more of a diversified approach where we're just literally taking all of this data and finding these amazing businesses.
Great. When you were going through this process, why did you decide to use the ETF wrapper vehicle versus a mutual fund?
Yeah, I mean, really for the tax efficiencies of the ETF, and frankly, again, in the last say like 10 or 15 years, there's a lot of platform partners that have launched that can do a lot of the operational heavy lifting that maybe a smaller company like Bancreek really wouldn't want to go down that endeavor, right? And so for us, we found a partner that could set us up on their platform, and really we could just focus on what we want to do is and that's portfolio management and improving our models. And so it was really because it was pretty convenient and easy to do, and kind of met with our timing and timeline of developing the engine where we became more and more confident in listening to the engine and just having the full quantitative expression.
Fantastic. Yeah, I talk a lot about innovation, how it's changed so much. And just like how you said, the innovation and the services that are out there for a firm like Bancreek to make it easier, more efficient to offer ETFs. It just helps everyone, right? From the retail investor to the asset manager. It's been fantastic.
Yeah.
And I like that you brought up, again, I talk a lot about know what you're investing in, right? You could invest in just a passive ETF, and before you know it, 40% of your allocation is in mega tech stocks,
Yep.
right? And are you all of a sudden diversified? And you could have a whole lot of overlap as a financial advisor in that client portfolio. I often talk about the Bloomberg egg. It is now 60, 70% treasuries. And are you really getting diversification? So I love that you brought up, really understand what you're investing in, know what's in there, because there might be some fool's gold there for some.
For sure.
We often talk about investing is very behavioral. There's behavioral science or finance. It can be very emotional also, getting attached to, a specific name that maybe a stock has been passed on to from generations. And
Yes.
that was evidenced by FOMO or YOLO, fear of missing out, or you only live once investment movement during the pandemic. So many times the meme stocks, I would just shake my head and be like, oh my gosh, what's going on here? But that has provided new data to consider and maybe add some challenges. How do you handle these new market environments of fear of missing out, YOLO, when you're trying to uncover trends through data, or even looking at fundamentals?
Yeah. I mean, for us, it all starts with the history, right? And so we need data that goes back a fairly long period of time for us to get interested in an asset or an investment. So anything that's meme related or not profitable, like that's not going to send a positive signal for what we've designed. So those companies will just tend to stay off of our radar. And then there's other companies that are growing and emerging that maybe right now are not a good fit for what we're doing, but if they continue to sustain edge and the structural advantage that they're developing and are able to avoid being disrupted, then over time our tools will like them. But really we're looking for companies that basically have proven the ability to cycle cash and grow, because growth is the most important part to compounding. So there have been wonderful businesses over the last 50 years that have compounded capital that have slowed their growth, and they might not be as interesting as they once were. And so for us, it's finding not only these are great businesses with an advantage, but that they can also continue to grow either organically or through M&A roll up, right? And there's quite a few of those. So our focus is start with the data and identify these companies. To your point, like the emotional, being able to remove emotions from investing is a blessing, because you don't get anchored to an idea that you came up with 10 years ago, and the company so well, management, like you get, they might go through a tough period of time, but they'll bounce back. For us, we're literally scoring every company in our universe, ranking them. And what you see in our ETFs is you get the top 30 at any given point in time. And if a company all of a sudden goes from 26 to 80, it leaves the portfolio. And we're using data to say, hey, that that is not as interesting of an asset as it was, a month ago, 2 months ago, or whatever. And let's bring in what we think is more interesting now because the data is telling us it's more interesting.
That's a great point about that emotional attachment. When you're a quantitative investor using data, there really, it removes that element and all bias. So that's a very good point, and it makes it the strategy more compelling than it already, because the portfolio managers, the asset managers, they're not going to be attached to a product because they've held it for 10 years,
Right.
and like you said, they know it's truly unbiased looking at
Yeah.
dkind so I'm really
And
glad
look,
about that.
the nice part is this has been, if you go all the way back to, when I started thinking about kind of these high quality companies with data science almost a decade ago, it's still kind of the initial framework for thinking about investing that I had. So if we look through the portfolio, a lot of these companies I've known for a very long time. So it's not like as we're updating it, all of a sudden it's 30 companies that I don't know what they do, and they're all random. Like, no, for the most part, if you start going through them, it's like, okay, yeah, that company makes sense. I understand how they generate cash flow. Like this all squares up, and that's the benefit of being able to have done that, having doing this for years and years, and then building it out with Anton since the launch of Bancreek.
I love it. Yeah, that's fantastic. So it's not like there's a lot of high turnover because they're falling in and out of the qualitative filters or anything, or quantitative filters. You still understand the names over all these years.
Exactly. Right. And, companies with the highest scores tend to be pretty sticky within the portfolio. So while you might see movement on the margin towards, the smaller positions, I would say like the core positions have stayed pretty consistent.
I love it. Thank you so much for that information, Andrew. So I like to end the conversations as we talked about earlier, something fun, anything interesting going. We're coming up on the holidays. Um, I can't believe it's already the holidays. Anything exciting going on?
Well, the one thing that I would, this isn't the holidays, but over the summer, we had the pleasure of ringing the opening bell at the stock exchange
Oh,
and at the New York Stock Exchange. And what was funny to me is we're up on the platform and I'm looking around, and it's like three of my oldest friends. We all grew up together. Our name Bancreek actually comes from the elementary school that Eric Backman, our chief analytics officer, and I went to school together at. And we went to Banyan Creek, and we ended up kind of putting the two words together to form Bancreek. But we played the stock exchange, the stock market game together in fifth grade. I remember this, and kind of going through the newspaper and looking at companies like Disney and seeing Berkshire Hathaway's price and being like blown away at the stock price. And it was kind of like this full circle moment for me. I'm looking around like, I can't believe we're like literally ringing the bell at the New York Stock Exchange, and I'm here with like my oldest friend. So it's been a wonderful journey and ride the last 4 years, and looking forward to seeing what the next four entail.
could you imagine when you were growing up and high school, thinking that in a few years down the road you're going to be at the New York Stock Exchange?
Never, never.
That is
Amazing
awesome.
experience.
Well, they should have a statue of you guys at your high school and growing up for making it to the New York Stock Exchange and ringing the bell. That's great. I love
Well, if you reach out to them, maybe that could make it happen.
it. Yeah, exactly. Andrew, it's such a fun conversation. Thank you. Thank you for sharing such great insight about the importance of data, looking through data, how to do it without, while eliminating the noise, and taking a quantitative approach to investment management. Such great insight. Where can our audience get more information about Bancreek Capital Advisors?
Sure. So there's our ETF website, which is bancreeketfs.com, and then our advisor website, which is bancreek.com, which we built additional tools just to share with investors because we think they're interesting, and it's things like around inflation and unemployment data that we kind of made our spin around, and we use Tableau, which is a really neat software tool to kind of analyze and present the data to the public. So feel free for everyone to come peruse the websites, and obviously if anybody has any questions, you can
Yeah,
easily.
Andrew, that website is fantastic. Like I said before, reaching out and having these conversations. I always go to the website and I read a lot of your thought leadership. There's some great content there about inflation on the economic side. So great stuff. I recommend all of our listeners going to it and taking a look at it. Andrew, thank you so much. I really appreciate you coming on. It was an honor to have you on and sharing such great insight. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a great rest of your week.